All right, yeah, just reviewing what happened the market. So today there was some interesting opportunities. Today is like one of those days that you don't get a lot. I mean, it happens once a week or once every 2 weeks, but basically it's a trend day, and or like a sell-off day, or you know that type of day where breakouts work and all of that. So what we saw was selling pressure, and over here, right here, break and break again. Here was a really nice opportunity. Why? Because when market goes to support and you see this bar, see that bar? That bar has a lot of activity. The most amount of activity in at least 10 bars. You know why? Because it's selling pressure. So at selling pressure at support, that means it's going to break through. So at support or resistance, so this is what that means, and it goes down. As it went down, over here there's some pressure. Over here there was a lot of pressure coming in. So the activity here, my box. This is one of the things that tells you, it's time to exit. All right. The other thing that tells you is that you have the most amount of volume here in 18 waves. So I mean, this is obviously a climactic action, and then you get it confirmed because over here, you have 210,000 shares traded, then only 37. So I mean, there's no doubt about it that this is a secondary test. As soon as it goes down and pops up and it's unable to break down, it means that selling pressure is gone, because it went down on 210 and then it couldn't go. It tried to go below, but it couldn't. So it's in that breakout or spring position, and the volume evaporated. So I mean, over here or here, you definitely need to be out, because there's no selling pressure coming in. That's your secondary test. So after that, all this activity came in. So you know that's going to bounce. You know that this activity right here is telling you it's going to bounce. Now, where is it going to go to? Obviously, one of the areas it can go to is the resistance area, because it's a trend day. So climax, secondary test. Now you have some rally over here. There's no volume. And more importantly, you must pay attention to this specific thing. Look, supply is doing what? Is it increasing or decreasing? It's decreasing. Supply is decreasing. Here, the demand increased. Here, it decreased. But the relationship now from demand to supply is what? Demand is stronger. And believe me, like the direction typically is in the direction of the higher volume. So over here, as soon as this establishes where you have rallies that have more volume than the pullback, or if you take a look at these two and the bottom two, what do you notice? You notice that the up waves have more volume than the down waves. And down wave already is exhausted, secondary test, another third test, and up waves have more volume, and it sets up the bounce. So I mean, that's what's going to happen. From SPY perspective, how long did these two waves last? Look, nothing. 3 minutes, 6 minutes. There is no lasting power, no duration, no lasting power. It is telling you it's going to bounce. So even if you're out in the market and you see this climax, you're not sure if it's climax or it's going to pop up and break. Here, when you see the secondary test, Here, when it only goes to 3 minutes, it is confirmed that that there is no selling pressure. And after that, activity picks up and it sets up the rally, but this rally is nothing more than a counter trend to test this breakdown right here with increased activity in the biggest bar, last 10 bars. So that's what it's going to do. It's going to test that, and that's exactly what it did. So you just have to know that this is going to be a test of the breakdown. And it's going to go up there. So all the activity is increasing. Boom, ready to go, ready to go, ready to go. And then after it tests, what happened? Activity picks up to the downside. Where? Right here. Activity picked up to the downside, right there. So on the test, selling pressure comes back in. What do you notice the volume say? The volume says, yeah, 278,000 of short covering. Bounces up to 47, bounces up to 10. What is the pattern of the volume? The volume pattern is, is 278 to 47 to 10. What do you think that is? This is classic, where you have higher than lesser, so it's very susceptible to a breakdown. And that's what happened. It broke down while the activity is increasing, 15, 16, 17, all increasing. I'm surprised it didn't break over here, though. Activity should have spiked over here. I don't know why it didn't. It spiked above here where it says 15, 16, 17, but below these pivots, it should have spiked. It did spike, not spike that much, but it was the biggest in 7 waves, 7 bars, but I expected more. And then pop. Get some activity on the upside to do what? To do the test. It's telling you that there's covering against these support levels, that they hit a liquidity or, whatever. They hit something. And then you just wait. Because if you're short, you just have to wait for activity increase, and that's exactly what it does. Where does it do that? Right here on the 27. Activity increases, it's short. Activity increase right there on a reversal, it's a short. And then what happens is, against this low, activity increases to the biggest in 28 bars. It's no-brainer, it's going to go down, and that's what it did. Right? Like it reversed. When price reversed, it has to reverse on high activity. And if it breaks down, it has to break down on high activity. Why? Because it's telling you it's going to sell off. It's a measure of selling pressure. So selling pressure increases after it turns, and selling pressure increases after it breaks a low for there to be continuation to the downside. Now the only thing is, at the end of the day, it goes all crazy, and I can't tell what's going on, because at the very beginning and the end of the day, it goes, as you know, it goes nuts. So down, 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 down until here. What do you see? End of the day, what happens? Activity picks up. If you're short, get the hell out right there. Why? 25, bigger than 6. So, that's game over right there. That's your short covering, and you're done. Anyway, what are the lessons here is that you have up, down, and break on high activity. It's going to go down until it's a climactic action. What do you look for? A secondary test. Right there is the secondary test. What is the other thing? The up waves have more volume than the down waves, establishing the possibility of a reversal to go back and do a test. Counter trend test, that's what happens. It does that. What tells you that selling pressure is done? Obviously the volume relative to 210, you have only 37 and 26, but what is the second piece of information? It's the time. And this you will not see anywhere online or on YouTube. Won't see it anywhere, because this is real Wyckoff. And what he used was time. He used time and price along with volume, not just wave volume. He used time and price. And here, if you have only 3 minutes of selling pressure and then only 6 minutes of selling pressure that can't even go break, which is the lowest in all these down waves, that means that from a perspective of time, you have 3 perspectives: time, price, and volume. And from a perspective of time, there's no selling pressure. Whereas when it rallies here, you have 18 minutes. So obviously there's buying pressure, because from the perspective of time, what do you notice? This is the biggest amount of time, lasting power, in 1, 2, 3, 4, at least 4 waves. And actually 5 waves. So it has lasting power. That's another thing you won't see online, by the way. So, and over here you see the lasting power, or whatever I want to call it, duration, the selling, how long it lasts. So Wyckoff explained that this is based off of lasting power, something like that. We call it duration. So look at the duration. Bang, 39 minutes down, pop, 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 reversal short, down she goes into covering right here. So make a long story short, one thing that's surprising though, not really, I need to see what the volume here was. Something's not right. Anyway, so there are a couple of key things. I want to list the takeaways. Number one, find it. Number one is climactic action to the downside confirmed by the low. How is climactic action confirmed? It is confirmed by small volume and less time, very little time on the down waves. So the volume here is only 37 relative to 210. Next 26 relative to 37 and 210, decreasing pressure. So supply is decreasing. And the up waves are now bigger than the down waves, which means what? More demand than supply and a counter trend rally. That's what happens. As it rallies, the next two waves here, again, decreasing. Big problem. Just like this supply, you see this is decreasing. Here, it's decreasing. Here, it's decreasing. So what does that mean? That means it's a problem. And as soon as the down waves are bigger in volume than the up waves, it's gonna reverse, because that's the law of supply and demand. And yeah, supply and demand has at least three factors, which is price, time, and volume. I'm just using one, but you can use. I'm using 2 and 3 up here, so I understand. But start with volume, and then you can add price and time, or vice versa. It's actually better to use price and time first, then add volume. Anyway, because why is volume critical? Here's the one question I'm going to put up, because a lot of folks will say you can get everything from price, or price is king, or some stuff like that. First of all, you forgot about time. The factor of time is as important, in my opinion, as either price or volume. In fact, it is much easier to read. It is much easier to read, because if you flip from chart to chart, different markets have different amount of volume, and you can't know what is high and what is low volume, because their average volume and daily volume is going to be different. But time will be consistent across charts. So the price, move, is it a lot or a little, is relative to the market. The volume that is from chart to chart or market to market is different. So those two things, you would have to know the market first in order to figure out, okay, there's a lot of demand and supply based on price and volume. But that is not the case with time. And that is why I believe that time must be used, because especially if you're tracking multiple markets, and I think it's easy to read. It's showing you sustained buying and selling pressure or lack thereof. So it's showing you strength as it's showing you weakness. So anyway, long story, let's move on to why is volume so important, because a lot of folks will say, well, we just use price, price is king. Price cannot show you climaxes. Price cannot show you climaxes. The concept of a climax requires volume, and climax is ending action. So what does that mean? That means that, I'll give you an example over here, right? You see it goes down, down, down. This here is telling you that this is climactic. Price is telling you this is a big wave, but you don't know if it's climactic. You can have a smaller wave than the prior wave on bigger volume, and then you think that the smaller wave is not climactic, but the fact that it has bigger volume than the prior wave makes it climactic. So only way to truly get look for climaxes is through volume and also the other factors. That one of the nature of volume and price is that it's not just confirming, it's something else. And to make it very simple, price has a tendency to go to where volume is increasing. So, for example, and you will see this, I'll show you this. Let me see. There are many, many times where you will have, you see this down wave here. I don't know, let's put like 100. All right. So we'll put 100, and let's make this a little bit smaller. Right? And that up wave there has 75. Let's go 75. You know what's going to happen if the down wave is bigger in volume than the up wave? It's very likely to reverse, because volume sets the pace of direction most of the time, meaning rally should have more volume than pullback volume. So in this case, you have pullback have more volume than the rally. So what do you think is going to happen? It's susceptible to a change in direction. So, I mean, over here, for example, right? I'll show you right here. So you're reading this, and it goes 210 to 96. Down, right? You're thinking, oh, it's down, down, down. Okay. But what happens here? 37. Now, 96 is greater than 37. Okay, but maybe, maybe the next wave is going to be less. And it is less. But guess what? The down wave is even less. So when you're comparing the up rally to the down, the up wave to down, you see 2 times that the up waves have more volume than the down waves. 2 times up wave have more volume than the down waves. And the down wave volume is decreasing, telling you what? Demand is stronger than supply, demand is stronger than supply, and supply is weakening, which initiates what? A move to the upside. You see? So, anyway, where was I? Then after that, this shit happened over here. An activity increased and puked. Right here again, it was activity increase right here where it says the 6. Why? Because they're getting ready for the next move. Move sideways, 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 break. Boom, right there. Break, but it's met with buying activity, and that sets up the move. So long story short, when you're looking for a reversal, even in consolidations, let's say it's a downtrend, if you're looking for a reversal up, look for demand establishing itself being greater than supply and supply decreasing. It's a key observation. And what is this? This is the climax. And this is also like over here is all weird, like heavy, heavy, heavy volume. But it's the angle of it is so poor that you should not be too bullish because something doesn't make sense. When it pulls back and it only finds 39, okay, it means it's going to bounce. But then, when you have 47 and you have 10, and I explained many times, you're not just comparing supply to demand. You're comparing demand to demand. And here you see demand decreasing, meaning 278, 47, 10. right? So that is your indication that there's a big problem. Just the same thing over here, 210, 37, 26. Again, 278, 47, 10. Decreasing volume on the down waves, setting up the pop, decreasing volume on the up waves, setting up the drop. That's all there is. So from a volume perspective, as long as your selling pressure is bigger than your buying pressure, it's going to go down, and the buying and the selling pressure is not trending down. Here it starts, here it increases, but now here it starts trending down, which is setting up the reversal. The other thing to note, obviously, demand to the supply. So these are some things that okay, now forget okay, now let me just say something else. All right, this is a very important thing. All right, now you know that many the two keys that you see successful traders have is they always do these two things. All right, review and prepare. These really are the two things. All right, in terms of having edge and all of that, all the successful traders they all fall in this category. This is a common thread between all traders. So I'll explain how this is done. The review part, you basically have three approaches. Number one, what was it? Yeah, they use screenshots, right? And then they mark up those screenshots, and you see them having like 100 screenshots. A lot of the pattern traders swear by this, right? So they're reviewing that way. The second way to do it is to write it out, and write up a summary. And then the third way, which you'll see, is Excel. Like they'll start breaking things down in Excel. So there's ways to do that. Usually you just, after looking at the same thing over again, you start breaking it down by did this happen, did this happen, did this happen, and then quantifying it. So for example, for a turning point, it would be something like, did a climax happen? Did a change of behavior happen? Did the lack of supply or lack of demand, last point of support, last point of supply, whatever it is. It's nothing more than this weak secondary test. Did that happen? And then they'll put in the numbers and all of that and be like, okay, now they see the ratio between demand and supply and all of that. And then, it gets all mathematical. Not really that mathematical. It's just some basic arithmetic, just tracking that. So when they review, these are three things that they do as part of the review. After that, they prepare. So never will you see successful traders just turn on the screen and look at one time frame and see what's happening on the 1 minute chart or a 5 minute chart and then just take trades. What they will always do is either before the market opens or after the market closes, draw levels, look at what's tested. They've done their review, and then they prepare for possibilities by drawing their levels and seeing what news is there and all of that. They go through like a checklist of preparation. So let me write that down. I have like a checklist of levels and all the way checklist. They might check Bloomberg. They'll see what levels are tested, untested. If they're using intraday point figure, they'll see what is the cause, and they'll map that cause to the potential to go to a certain level. I'm going to show that right now. You see today's sell-off? Let me show you something. This is a point figure. I like it a lot. I find this is really good. I was really shocked. Like a very, very simple point figure. This is the original point figure, which only had X's. It did not have O's. just had X's. And when it just has X's, you're more focused on cause as well as support and resistance, by the way, and not, anyway. So for example, this is the breakdown. So you can take a line across here. This is the resistance, that's the breakdown, that would be it. Right? So we see that the count is about 15 or 16. And you can use an earlier count like across this level as well. Right? Because there's, I mean, it just goes to resistance. But this right here, where's my, right here is the breakout. Right? So before the breakout, that's really what you want to use. So anyway, where is it? 15. Okay, I think it's 15. I'm looking at the count. And then the effect of that would be 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. So it's projecting about here. That's not bad. Right? Right before the breakout, use the low before the breakout, do the count. Actually, it's 16. 1, 2, 3, 4, 5, 6, 7, 8, 9, 11, 12, 13, 14, 15, 16. Holy shit. So it's like one more box. So I mean, there's 15 or 16 is right in that area. Now what you do is you combine that cause with the resistance level, and that resistance level is right there. And surprisingly, it goes there, stalls, and pukes. So, and this is not like just one phenomenon. I mean, I'm seeing this happen it doesn't happen all the time, but it's really good. You have stepping stone counts right here, for example. It's like 10, I think. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, around here somewhere. Then you have this little count. It goes up, goes to resistance. So you're using the point and figure count with the resistance levels to see if the count is projecting. And if there's projecting to that resistance level, I think that's there's something to be said about that. Anyway, long story short, whichever methodology you use, it requires all the successful traders that I've seen using crazy methodologies, like, you know, some of them just using breakouts, others using VWAP, and I don't know what else, others using just MACD with some averages, momentum trading. All of them basically have one thing in common. They do these two things, review and prepare. And they spend a lot of time in reviewing and preparing. And it's like they take when you review, you're basically doing what? You are synthesizing data. You know what happens when you synthesize data? It automatically leads to insight. So they're synthesizing data using whatever tools they have, leading them to insight. Then they're combining that insight with preparation. What happens when you combine insight with preparation? You increase your judgment. You increase the success of your judgment. This is what's going on. And this is really the underlying thing that's happening with all those traders, some using Elliott Wave, some using Wyckoff. All they're doing is synthesizing market information, using their tools, giving them insight, then preparing. Insight plus preparation leads to superior judgment. Anyway, long story put into a 30-minute video. Take care. Have a good day. Bye.